Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me once again Keith Weiner. Keith is the CEO and the founder actually of Monetary Metals. That's a leading authority in the areas of gold, money, and credit. And he's made many other important contributions to the development of trading techniques founded upon the analysis of bid-ask spreads. And he is a founder of Diamondware, a software company sold to Nortel in 2008. And he currently serves as president of the Gold Standard Institute, USA. He earned his doctorate from the New Austrian School of Economics. Welcome, Keith. It's good to have you back again.
Thanks for having me, Jay.
You know, Keith, I want to talk to you today about an article that you just wrote, October 7th, titled The Toxic Stew. And I've actually titled today's show, Guaranteed the Swiss franc will collapse. I titled the show that because of I thought it was a really interesting article, The Toxic Stew. I'd like to back up a little bit for the sake of listeners who may not remember what took place, but I believe it was back around 2015, wasn't it, when the Swiss franc started to gain so much strength vis-a-vis other fiat currencies? Is that right?
So at that time, the Swiss National Bank had a peg on the Swiss franc. And so the price wasn't changing, but what was happening was the pressure was mounting, pushing against that peg. And then it finally snapped in January of 2015. Now, what's remarkable about it is people are obviously very familiar with Banana Republic that try to say that, our peso is going to be, 2 to 1 to the dollar. Mm-hmm. And then when the market decides that they don't really believe their credibility anymore, they start selling pesos, which obliges that central bank to buy the pesos and sell dollars. And everybody understands that's a very short-lived process because then they run out of dollars.
Yeah.
And as soon as they run out of dollars, then they can't maintain a peg anymore. The Swiss National Bank was doing the opposite, right? They were trying to keep their currency from going up. Mm-hmm. Not down. It wasn't a Banana Republic of Switzerland. And so they said in mid to late December, it was like less than a month before the peg actually snapped, the Swiss National Bank president, Thomas Jordan, said, we're going to put unlimited resources. We will beat the market. We can maintain the peg. Mm-hmm. And you would think, okay, well, all they have to do is print francs, right? And they can do that to infinity. Mm-hmm. And so there'd be no problem keeping the Swiss franc down. Uh-huh. They wanted to keep it at, they wanted to keep the euro measured in francs at 1.2 francs.
Yep.
And so people kept selling the euro to buy francs, so that was pushing it up. And so, eventually the Swiss National Bank hit what had to be their stop-loss order, and got overrun, and then the peg snapped, and the euro briefly spiked down to, I want to say it was 0.89.
Wow.
Something like that. It was
quite a move.
30% move, 30, something like that, in a matter of seconds. Which was something like 6% of Swiss GDP was lost in that, 3-second period over this move. And so it was a remarkable move, and that was January of 2015. Mm-hmm.
So in fact, the opposite happened of what was supposed to happen. I mean, you would think if they could print enough Swiss francs, they could hold it at that level. You would think that probably it would have a stimulative effect. I mean, this is Keynesian thinking, I guess. It would have a stimulative effect on the economy, would drive interest rates up. But in fact, the opposite happened, right?
So everybody assumes they're printing. And so, you're printing more money. Quantity theory of money says the more you print, the more your currency is going to go down, which drives prices up, stimulative to GDP. Mm-hmm. Interest rates have to rise because of inflation expectations. That's all the mainstream theory. And by mainstream, I really mean the Keynesians believe that, or a version of that. The monetarists believe a version of that. Mm-hmm. And the Austrians largely believe a version of that as well. Mm-hmm. But it turned out all to be wrong. Mm-hmm. And the first thing you have to understand is it's not printing, it's borrowing. Mm-hmm. And I feel like I'm alone against the entire universe of economics in saying it's not printing, it's borrowing. Mm-hmm. And I will say that, I will get on the rooftops and bellow at the top of my lungs until either I run out of breath or until the world hears that. It's borrowing. Mm-hmm. The Swiss National Bank is borrowing to sell the franc to buy euro-denominated assets. I assume that would largely be German funds. Mm-hmm. The German bond, but maybe they bought Spanish and Italian, I don't know whatever else they bought, but they were borrowing. And so now you have a currency mismatch. You're short the franc and long the euro, and if the euro goes down and the franc goes up, the thing you're short is going up, the thing you are long is going down, that spells losses. And, if you're the portfolio manager of a hedge fund and you're doing a pair trade, it's an arbitrage short one thing, long another, and the thing you're short is wanting to rise violently, and the thing you're buying hand over fist is falling, you've got to get to that point. If you don't get to that point, you're going to be bankrupted, or you get to that point where you say, uncle, you throw your arms up, I can't do this anymore. And then they let the peg, snap, and that caused a lot of pain because, so people look at this and say, well, why would they care to keep the franc down? And so the mainstream answer, and again, by mainstream, I mean all the major economic schools would have a version of this, that, well, all the Swiss exporters are hoping to gain an advantage by having a cheaper currency. Whether you're Nestle, whether you're Rolex, I guess Rolex, I don't know if Rolex is owned by Swatch Group, but that's the big Swiss watch company, whether it's Ciba-Geigy, the drug company, whether it's, I'm trying to think of the other.
Yeah, the point is the same idea, that keep the currency low so you can export more. Yeah.
Right, but I'm sure those companies were lobbying, but there's a much more important reason why everybody in Switzerland care about the currency being down, and that is the banks. So Switzerland's a relatively small economy with a very, very large, outsized banking sector.
Sure.
And so all those banking deposits come flooding into a small country. There is no investment opportunity in Switzerland for all that capital that's rushing into the Swiss banks. Now, the deposits are Swiss francs, but the investment opportunity is going to be euro or maybe even Hungarian forint, whatever else outside of Switzerland. So again, if you're that bank, you're putting on this trade where you're short francs, long something else, the banks are probably saying to the Swiss National Bank, hey, cover us.
Yeah.
We're going to be insolvent, right? I mean, if the euro keeps falling and the franc keeps going up, we're going to be insolvent.
Yeah.
So that's what was at stake. And sure, Nestle and the other exporters were probably lobbying, but I don't think that was, I think that was secondary importance to the banking system.
Yeah. All right. Well, I think you made a point that's I guess even the Austrians don't quite get, as I was listening to you, the idea that it's not the Weimar Republic where you're literally printing money and showering it from helicopters, is it? You are borrowing, it's debt. So I like to say that debt is the raw material from which money is created in our fiat system. Would you agree with that?
I don't, because I make a particular distinction between money and credit. And so I just like to use a very simple example going back to the 19th century when we had the classical gold standard, and that is you could bring a $20 bill to a bank and wordlessly, I don't think you even had to speak, push that across the counter to the teller, and the teller would push back a coin made of approximately 1 ounce of gold. If the word for the paper is money, what is the word for the gold coin that comes back to you? And of course, in those days, the bank deposit was created by, or the $20 deposit was created by bringing the gold to the bank in the first place. So you deposited money in the bank. That was just nothing more than the note, or the promissory note that says, we'll give you your money back. And so today we've changed the definition of money. Now it just means medium of exchange, and so forth. But I think the money is the gold, for two reasons, which is one, if the money was the paper, then what's the word for the gold? And I think that sort of shows the contradiction. But number two, there's a big difference between the physical commodity, whether it's gold or whether it's salt or whether it's cattle, versus the paper, and that's a physical object that exists. The paper, if you have a dollar, you don't actually have a thing. You have a relationship of owing that someone else owes you.
Right.
And if you have a gold, not only gold does not, no one else owes you, but you have a physical thing, you can take it and do whatever you want with it. But if somebody else owes you, it's now subject to their, terms and conditions that they're going to honor or not.
I think of it as an asset-based money as opposed to a liability-based, you don't call it money, but medium of exchange, I guess, is what we have. Right. Okay, well, I'd like you to help us understand a little bit how the dynamics you were talking about, the Swiss National Bank's activities in pushing rates down into negative territory, how that is pathological and how that will lead to the destruction ultimately of the Swiss franc.
So I think it happened as a byproduct of them trying to maintain this peg. They were frantically borrowing as many francs as they could, and then trading them to get euro-denominated assets. And so what they did is they, in a free market, money or credit is not created needlessly. There's a market signal, which is it's profitable to do so. A central bank can act outside the profit motive, which is touted as a good thing, but it's actually a bad thing. So they created all of these francs for which there was no productive purpose, dumping them into the market. Now the theory is increase quantity money, increase buying and bidding on prices and so forth. But what actually happens? Suppose you run a pension fund and you own a euro-denominated bond, you own a German bond, and then the Swiss National Bank raises the bid price, and so you sell the bond because you're like, they're paying too much. I'm going to dump it on their bid. So you bought this thing at I don't know, say 1,000 francs, and now they're paying you 1,001 francs to buy it off of you. You're not going to go and spend 1,001 francs or even 1 franc on consumer goods. I mean, you're running a pension fund. Right. That would be embezzlement, right? So now you have 1,001 francs, you have a capital gain, that's nice, and you're going to enjoy that for about 5 minutes until you realize, oh crap, I have to buy something else with. And what are you going to buy? Franc. What are you going to buy? So you go into the franc asset market and you find that all of your peers have the same exact dilemma, that the Swiss National Bank has bought all these yielding assets off of them. And so you find a relatively depleted asset market, and more bidders are coming with more and more cash, Swiss franc cash to buy on them. And so what you find is negative interest rates. That is, if you buy a bond that is going to return 1,000 francs to you in 5 years' time, or even in 2015, even in 10 years' time, or 20 years' time, it's going to return 1,000 francs. You have to pay more than 1,000 francs on a zero coupon bond to get 1,000 francs back in the future. Stupid. And so what that's basically saying is there's several perverse things about it. One is it's saying they created so many useless francs, there's literally nothing productive to do with them. Number two, and this is why I call for the destruction of the currency, or not, I diagnose it as a cancer, is that so in a normal world, if you run an enterprise that destroys wealth, it produces less than it consumes, you should be out of business the sooner the better, so that all the resources, including the people that you employ, can go to somebody else's hands who's doing something better with it. But now suppose you can borrow at minus 2% interest, just to make the math easy. Now, it's not that low in Switzerland yet. So let's say you can borrow at minus 2%. Now, suppose you destroy wealth at minus 1%. But you can borrow at minus 2%. You actually have a net profit of 1% at the end of the year, positive. So it is profitable. It becomes profitable to destroy. And I think the implications of that cannot be understated, because the nature of markets is that if something is profitable to do, then enterprises will scale it up and keep scaling and become bigger and bigger and bigger until it's no longer profitable to do. Now, let's say it's profitable to sell hamburgers, in a restaurant on the corner. You can only scale that up so far, and then what you find is the more hamburgers you dump onto the bid in that corner, the lower the hamburger price, and the less profitable it becomes to do that. And so in the free market, everything is self-limiting because there's only so much buyer. But in this case, if the central bank has flooded the market with useless francs and the interest rate's pathologically negative, then there is no end to the ways that you can destroy wealth at a slightly lesser rate than the negative interest that you're getting the francs in the first place.
It's incredible insight. I don't think there's very many people that see this. I don't, that's why I wanted to have you on, because to me, when I started reading this, it makes so much sense. But if people aren't indoctrinated, they don't think for themselves, they're all the economists at the Fed are Keynesians, they would have a hard time comprehending this, would they not?
I would say, from the ones I've met, and I've met a few, many of them are what you would call monetarists. The monetarists and the Keynesians regard each other as mortal enemies and think they're all the difference in the world. To my perspective, they're pretty similar.
Yeah, exactly.
No, they wouldn't see it this way because they have these equations that purport to, predict the economy. And in a way, they sort of fancy themselves physicists. So, you have a container and you pump a gas into it and, was it Boyle's law? I forget now. PV equals nRT, it's pressure times volume equals a constant times the temperature and something else. It's been a while since I've studied that. And they think that they can describe an economy in the way a physicist can describe a gas pumped into a container. And they can't, for a couple of reasons. One is obviously people are irrational and think and are creative and have free will. And then number two, people respond to incentives. And these equations don't really recognize incentives. So I wrote this paper in 2015. the Swiss franc will collapse. It got a lot of play in all the usual places that you would expect it to, zero hedge, the gold community. And in the more mainstream places, it was either ignored or very controversial. And you can imagine I took some flack for writing it. But, as with all these things, I just say, okay, do you have a substantive argument? I mean, if you think I'm wrong, tell me where I'm wrong. Don't just wave your hands and don't just sneer at me,
Yeah.
And I didn't get any of that, of course. And so, I think my argument stands that, yes, if you create the perverse incentive to destroy, people will take you up on it. Mm-hmm. And if people are destroying at any significant scale, then, that will eventually lead to, collapse. And so in my 2015 paper, I said, look, I can't predict how long it's going to take. Mm-hmm. I said, it wouldn't surprise me if it took months. It wouldn't surprise me if it took, a year or years. Mm-hmm. I just don't know.
Yeah.
But I think this is pathological. I don't think interest rates are going to return in Switzerland. And they've ticked up a bit. The whole world interest rates have ticked up since 2016. But it's still negative out to the 10-year bond or 9-year bond in Switzerland. The 20-year bond is now positive. Mm-hmm. At the time I wrote that, 20 was negative. Mm-hmm. But the whole thing is drowning. So I published a curve in which I made everything below zero red, if I recall. It's just to indicate, like, you're drowning, you're underwater.
Yeah, exactly.
And you're not coming back. It's not the hot thermonuclear explosion of hyperinflation. It's the cold, lonely death of drowning.
Right. Okay, Keith. Keith, let me ask you this then. We're looking now with rates rising. A lot of people very concerned about the rising interest rates in the United States. U.S. Treasury now is $22 trillion. So an increase in the interest rate of 1% increases, $220 billion a year for the U.S. debt. The debt keeps getting bigger and bigger. The U.S. debt, global debt, keeps getting bigger and bigger for reasons. I guess it's been encouraged to get bigger for the reasons you just given. That all these central banks have been involved in the same pathology of printing excess amounts of money. How do you see this working out now? Because I believe that the authorities have already positioned themselves for more negative rates and for bail-ins the next time we have a global catastrophe, which I think, I don't know if you're in agreement with this, but it seems almost not a matter of if, but when. How is this thing going to play out? Because what you're describing is a death spiral for the franc. Yeah, a little bit of a reprieve right now with the U.S. leading the way to higher rates, and I think they would like to get back to normal, but can they? And when this thing, if you agree with me that we're going to see another debacle here, another implosion, give me your take on how this is going to work out.
So that's a broad question. But so first of all, I think that the long-term interest rate trend remains downward. Mm-hmm. That is, we're in a correction, nothing more. And, so I've written a whole theory of interest and prices in a paper currency that interested readers can go to. But I think maybe the simplest way to describe it is by reference to a couple of things. One, I still see commercials on TV every day. Like if I'm at the gym, I'm on the treadmill, I'm captive to whatever they got on the screen. All the major car companies are still offering 0% for either 60 months or 72 months. Mm-hmm. Now, the cost, so that's a subsidy that they're providing to move the iron. The cost of that subsidy has increased very dramatically with the increase in interest rates, obviously. So I think I wrote an article, it must be 6 or 8 months ago now, different back of the envelope math, the increase in the cost of that subsidy, so not including whatever the baseline cost was in 2014, but just simply the increase since 2014, my very rough back of the envelope arithmetic said that was costing Ford either $1 billion or $1.5 billion a year. Mm-hmm. The increase, and it's gone up since then even more. Now, Ford had at the time a total bottom line of like $5 billion. So a significant chunk of their bottom line was eaten up in the increase in interest rates between then and now. So why would Ford be doing that? And it must be a marketing problem that their marketing people look at it and say, if we take this away and we tell buyers that from now on you have to pay, I don't know what it would cost them to break even on financing their cars, mm-hmm. but 4.9%. Mm-hmm. If we tell people you have to pay 4.9%, sales volume is going to drop off a cliff.
Wow. And
since we have obviously high fixed costs, we have all these plants and everything else, and union agreements, we would lose more money buys a loss on volume, then we're going to lose by subsidizing the credit. And I like to frame it in terms of relationships like that, because I think that's how economics really works.
Right.
That if you want to understand whether rates are rising or falling, understand whether every uptick causes an increase in demand for credit, or whether every uptick, which means more people selling more bonds, and the higher the rate goes, the more people want to sell more bonds. That is not the environment we're in today. That was the environment of the 1960s and 1970s. Today we're in an environment where there's very, very soft demand for credit, except on a downtick in rate. So the consumer got used to 0% financing. Well, you also see it in furniture. They sell beds this way. They sell, I'm trying to think what other products I've seen. I think they're even selling like plastic surgery. I think I've even seen ads for that, where, come in, do a whole facelift, we'll work you over $20,000, and we'll give you 0% financing for 5 years, right? The consumer really only has demand for credit at 0%. And if you charge them the market rate, all that demand dries up. And so right now, these companies are trying to hold the line, and they continue to sell bonds, even at the current market rate. But it has got to be a very lethargic, very sluggish, very trailing kind of demand. And so that's one way to look at, are we in a rising or falling interest rate environment? It's a falling rate environment. Demand is very sluggish. Demand for credit is sluggish, except on the downtick. Every time it ticks down, then you get a renewed shot of demand.
Yeah, it's easy for me to see longer term that to agree with you that I think rates are heading down, because when we have another financial crisis, which I think is just, I don't know, do you agree with that inevitably as rates are rising, there's going to be a point where it's, we're going to have an implosion, a financial crisis, when the margin clerks are going to call for their repayment, and you're going to have this sort of cascading domino effect like we had 2008, 2009. Do you see that happening, and then we're back to increased negative or bigger negative rates in the future?
There was a graph published by the Bank for International Settlements in 2015, and it was a graph showing zombie debt. So they the Bank for International Settlements defines a zombie corporation as basically a mature company. So it's not a company with like huge upside like a Netflix, but just a mature industry company whose profits are less than its interest expense. So in other words, it only exists by dint of really low rates and a very forgiving credit market. Yeah. Because in a normal world, they wouldn't be given credit. They'd be shut off. Like a drunk at the bar at 3 a.m. Okay, we're shutting you off. Right. So at that time, the percentage of zombie credit to the total corporate bond market was, I want to say it was over 10%, and the curve was tilted very steeply upwards. It was rising very rapidly. My goodness. In 2015. Now, what that means, and so that was before interest rates were rising when they produced that, or just the first bear uptick. So that means there's a very large percentage of companies that are marginal. That is, they can't really afford to pay their debts, even when interest rates were pegged at zero. And now you're going to raise rates. So when you raise rates, you're obviously going to bankrupt the marginal debtor. And by definition, the marginal debtor is the guy who defaults when interest rates tick up. So that's another way of looking at, are we in a falling trend or a rising trend? The debtors are all, there's a very large percentage of debtors are marginal. And so if you tick up, you're going to destroy them. That is what sows the seed, or that is the first seed of the financial crisis, is that X amount of debt defaults. And now that stresses the creditors. Yes. Because the creditors are themselves leveraged. Yes. And using duration mismatch, which makes it even worse. Short-term funding and long-term liability. Right. Their funding can be pulled very rapidly. Right. And if their debtors are defaulting and they're leveraged, then suddenly that blows a very large hole in their balance sheet. And then the whole thing unravels and everyone says, gee, what's going on? Well, it's the rise in interest rates. So obviously, I shouldn't say obviously. That's not the correct word. When this happens, then interest rates are going to have to reverse in a hurry if they want to try to stave this off. Now, whether they'll be successful at staving it off is a different thing, but that would be the obvious move for the central bank. All right. With just a couple of minutes left, Keith, what's the remedy for this? Now, I know your firm, Monetary Metals, is put together for investors an ability for them to earn a return on gold. The excuse always for not owning gold is, well, you can't get any
you can't get any return for gold. So why would you own it? You hold it. It actually costs you money to hold it, so you have a negative return. Why would you want to own the stuff? But your firm is providing a way for people to earn, maybe net 2% or so on their gold holdings? Tell us a little bit about that with a couple of minutes left, and how this may be one way that people can protect themselves against this spiraling downward trend of interest rates.
Yeah, so the interest rate in gold I don't think is subject to manipulation by the central banks, which is, of course, one of the reasons why they have to hate it. There are many reasons why they hate it, but that's one of them. So we've had, so the company is Monetary Metals. We've had, deals ranging between 2% and 3.75% net to the investor. That is gold on gold. So if you have 100 ounces and the interest rate is 3%, at the end of the year you have 103 ounces. More broadly, there's a reason why we're doing this. And the answer is there is no way out in the paper monetary system. It's trapped by its own design, or its own design flaws, and it's headed on its trajectory, which is down. The only way out for people is we have to build a transition path from the irredeemable paper dollar to gold, and that transition path is the paying of interest. So long as gold doesn't earn interest, it can never circulate. It just becomes another speculative asset in the Fed's casino. So if it's paying interest, then it can circulate and it can perform the job that it performed for thousands of years, which is financing productive activity. And so that's what we're doing with it.
Okay, well, I guess investors then still have to pay taxes on the interest earned, I suppose. Your 100 ounces of gold get you 3 additional ounces at the end of the year. I suppose that's up to their tax accountants to deal with that. Anyway, how can people, where should they go to learn more about your programs, Keith? What's the website that you go to?
The website is monetary-metals.com.
Monetary-metals.com. All right, Keith. Well, it's really great insights, a very unique way of looking at things. We like to explore new ways of looking at things, and you certainly have provided a lot of food for thought. It certainly makes sense for me, and I'm very thankful that you could come and spend some time with us today.
Thanks for having me on the show, Jay.